Stop what you're doing, seriously. If you follow the tech and semiconductor markets, you absolutely need to see this. Last week, I dug deep into the SC filings and order books for Aehr Test Systems, and honestly, what I found completely shocked me. We are looking at a stock that has completely defied traditional financial logic right now. I'm talking about a company with a fundamental Piotrowski F-score of literally 0 out of 9, yet it's trading like absolute gold. Welcome to this explainer. Today, we're decoding this massive momentum disconnect, and I'm going to give you a clear, actionable framework for understanding how forward-looking AI orders can just totally override ugly trailing financials.
So, here's how we're going to break this down. First, we'll look at this wild momentum disconnect. Then, we'll decode the actual cash burn. After that, we're diving into the massive AI order surge, the specific silicon photonics catalyst driving it all, and finally, we'll navigate the very real risks you need to know about.
All right, Section 1, the momentum disconnect. Let's start with the immediate, on-the-ground reality of AHR's explosive and, frankly, highly volatile recent market performance. If you've been watching the charts at all, you know this thing went from sleepy to jet-powered in literally a matter of weeks. Just wrap your head around this number, 144% run-up. We're talking about a stock that surged over 14% in a single day and more than doubled in about half a month, rocketing from roughly $37 to over $83. We are seeing these massive, fast spikes and deep intraday wicks. You know the drill. That's classic price action for when momentum funds start aggressively chasing a narrative.
But that brings us to a really bold question, right? How does a company that is actively bleeding cash see its stock absolutely skyrocket like this? To give you some context on their financial health, or lack thereof, Aehr currently sits with a Piotrowski F-score of 0 out of 9. 0. They literally pass none of the basic profitability, leverage, or operating efficiency tests. Nothing. So, why the massive premium? Let's get into Section 2, decoding the cash burn. Because before we can even begin to understand the hype, we really have to look at the grim reality sitting right there in their SEC filings today. I mean, just look at this trailing data for fiscal year 2025. It is stark. Revenue declined nearly 11%, down to $59 million. Operating margins? They fell to negative 9.6%. And that free cash flow? Wow. It essentially jumped out of an airplane without a parachute, plummeting over 1,300% to a negative $12.4 million. The company morphed from a cash-generative equipment business right back into a cash-burning machine, heavily driven by stockpiling a ton of inventory ahead of anticipated demand. And check this out, because it brilliantly illustrates the context you need for their historical profits. Back in fiscal year 2024, they reported a seemingly pristine net income of $33.2 million. Sounds great, right? But their actual operating income was only $10.1 million. That means their apparent earnings peak was driven way more by below operating items and accounting accruals than by, a sustainable step change in core cash generation. You've got to be cautious here. The earnings quality ratio is incredibly low. Okay, moving to Section 3, the AI order surge. So, with trailing financials looking this grim, why on earth is the market rewarding them? Well, let's pivot to the beautiful future and explore the incredible catalyst that actually resolves this whole mystery. It all comes down to the order book. Let me introduce an absolutely crucial metric here, the book-to-bill ratio. This is just a simple way to measure the new orders a company receives versus the units they actually ship and bill for in that exact same period. Aehr's ratio right now, it's greater than 3.5x. That means for every $1 single of product they are shipping out the door today, they are booking $3.50 in brand new orders. They are booking business vastly faster than they can actually fulfill it. Visualizing this disconnect puts the whole story into perspective. In their third quarter, their recognized revenue was just $10.3 million. That's a number that definitely disappointed on the income statement. But that trailing revenue is absolutely dwarfed by the $37.2 million in new bookings they secured in that exact same quarter. The market doesn't care about the past. It is entirely focused on that massive surge of new orders. And where exactly are these orders coming from? Well, Aehr's CEO, Gain Erickson, pointed out that these orders highlight the accelerating demand they're seeing for their Sonoma systems. These systems perform package-level burn-in for high-powered AI and compute devices. They've been landing multi-million-dollar orders from premier Silicon Valley test labs and leading-edge AI companies. Honestly, customers are practically lining up around the block for these fully automated test systems. Which brings us to Section 4, the silicon photonics catalyst. What's really fascinating here is the specific technological application that hyperscale data centers are absolutely desperate for right now.
The demand we're seeing isn't just generic tech growth. It is highly, highly specific. It's being driven by ultra-high-powered AI processors in the massive hyperscale data centers required to run them. Specifically, silicon photonics, which is using light instead of electricity to move data, is quickly becoming critical, must-have infrastructure. These optical I/O and interconnects are absolutely required for next-generation AI training clusters. And Aehr? They provide the crucial 300-millimeter wafer-level burn-in systems, like their Fox XP platform, to thoroughly test these high-powered devices before they ever get deployed. What makes Aehr's solutions so sticky for these customers is the incredibly seamless transition they offer. Customers start out with engineering qualification using the Sonoma or Fox XP system. Once they're qualified, they don't have to change their hardware or rewrite their test programs. They just add Aehr's automated loader integration, and boom, it moves them immediately into continuous flow, high-volume production. It's a completely hands-free, lights-out manufacturing setup that significantly reduces a customer's time to market. It's a total game changer. All right, Section 5, navigating the risks. So, yes, the future looks incredibly bright on the order side. But we have to ground this explainer by returning to some impartial analysis and navigating the very real market headwinds you might face here. Because it is absolutely vital to remember what you are actually paying for today. The current headwinds are substantial, guys. Aehr is still operating with negative margins. And because of the stock's massive run-up, investors are paying a breathtakingly rich price-to-sales multiple of roughly 52.8x. That is steep. Furthermore, they have a massive $42 million in cash tied up in an inventory buildup. The market is pricing in absolute perfection and massive future growth, definitely not current earnings. And here's an interesting tidbit. While retail investors are aggressively buying into this future AI narrative, it's really worth noting the tape on insider behavior. Recently, top executives, including the chief technology officer and the EVP of research and development, sold low to mid seven-figure sums of Aehr stock. Now, while they do still retain sizable positions, insiders have definitively been taking millions in profits off the table during this latest stock run-up. Just something to keep in mind. Which brings us to our final takeaway. The core of the Aehr story is a weak present going head-to-head with a powerful future. The bookings are undeniable, for sure, and their technology is sitting right at the crossroads of the massive AI and silicon photonics build-out. But the question you really have to ask yourself is this. Can Aehr execute and convert that massive backlog into sustainable revenue fast enough to justify its current sky-high premium valuation? It's a classic battle of forward momentum against trailing financial reality. Thanks so much for joining me for this explainer, and I'll see you in the next one.